Welcome to the Deep Dive. Today, we're looking at execution in the incredibly high-stakes world of autonomous vehicles.
We are. Our focus is the third quarter 2025 earnings call from Pony AI.
And this call really is a key health check on that massive, capital-intensive race for level 4 autonomy.
It's essential, Pony AI sits right at that intersection of high growth and high burn.
Right.
So we're really examining how a company that just raised nearly $1 billion is using that cash while also trying to prove its whole business model can actually break even.
So the mission today is really gauging velocity versus capital discipline.
Exactly.
Okay, let's start with the top line numbers, the performance that really got the market's attention.
For sure. So revenue came in at $25.4 million for the quarter,
which beat the consensus of $22.8 million. That's a solid beat, over 11%.
And it wasn't a marginal beat,
Yeah.
It was powered by some real momentum. Year-over-year revenue growth was up about 72%.
72%. And that's compared to $14.8 million this time last year?
That's right. Then you look at the profitability, and the non-GAAP EPS was negative $0.14.
A loss, but a huge improvement from the negative $3.51 they reported a year ago.
A massive improvement.
So for listeners who are tracking the accounting on this, what's behind that huge swing in EPS?
It's mostly share count normalization after the IPO. But the real story for the business's health is in the efficiency gains.
You're talking about the gross margin.
Exactly. Gross margin nearly doubled. It jumped from 9.2% to 18.4%.
That's a 920 basis point improvement. That's huge.
It signals that real scale efficiencies are starting to kick in, which is exactly what you need to see.
And what was the engine inside the business driving that margin expansion?
Well, the star of the show, without a doubt, was Robotaxi fare charging revenue.
Okay.
That specific line surged 233% year over year. That's premium volume, and it shows people are actually using the service.
And the management tone on the call reflected that success.
Oh, completely. It was constructive optimism. They kept emphasizing that 2025 is this critical transition year.
Right, from a pure R&D startup to a company that's all about mass production.
Precisely.
Okay, so that transition is what we need to unpack. Let's dive deeper into the core financials, especially that revenue mix.
Absolutely. The Robotaxi services revenue, that grew a strong 89.5% year over year to $6.7 million.
And the robo truck.
That's a more mature segment, a bit steadier. It grew 8.7% to $10.2 million.
But the most interesting piece, the part that signals their big strategic pivot,
was the licensing and applications revenue. Explosive growth there. It shot up 354% year over year to $8.6 million.
And that licensing revenue is the first real sign of what they're calling their asset-light strategy.
It is. But the pivotal takeaway, the moment that validated the entire level 4 model for investors.
It had to be the Guangzhou break-even.
Yes. Achieving city-level unit economics break-even for their Gen7 Robotaxis.
That is the ultimate proof point for this whole industry right now.
It means the revenue from the car, after you subtract costs like cleaning and energy, is actually covering its daily expenses at the city level.
And they gave specific numbers for that, didn't they?
They did. Daily net revenue per vehicle hit 299 RMB, and that was fueled by an average of 23 orders per vehicle per day.
23 orders a day. That's incredible utilization. But let me play devil's advocate here for a second.
Go for it.
Guangzhou is a high-density market. They know it well. Can they really just copy-paste those economics to a new market, say somewhere in South Korea or a less dense American city?
And that is precisely the challenge. It's why the market is still a bit skeptical, even with this validation.
So Guangzhou proves the concept.
But now they have to prove it can work everywhere else. And to do that, you need capital, which brings us right back to the balance sheet.
Because scaling is incredibly expensive. We see revenue and margins improving, but the cost of deployment is just ballooning.
It is. GAAP operating expenses rose almost 77% to $74.3 million.
And the non-GAAP net loss widened to around $55 million. That just screams heavy spending.
Right. They're spending money faster than they're earning it, which is, expected at this stage.
They also called out a one-time R&D charge, didn't they?
They did. A $12.7 million charge tied specifically to getting those new Gen 7 vehicles out the door.
So before their big capital raise, what did their cash position look like?
They were sitting on about $587.7 million in cash and equivalents.
Necessary, but not nearly enough for the long haul in this race, which leads us to the strategic anchor of the quarter.
The Hong Kong dual listing.
Yeah.
That dual primary listing on the HKEX raised a staggering amount, over $800 million. Let's call it about $860 million in fresh capital.
That's not just a liquidity injection. I mean, that fundamentally shifts the power dynamic.
Management called it the necessary war chest.
Yeah.
And that's exactly what it is. It lets them accelerate mass production heading into 2026.
Nearly $1 billion. It just reminds you of the cost of entry here. So for the listener, what does a capital buffer that big actually translate to in terms of runway?
Well, based on their current burn rate, analysts figure it gives them about 14 to 15 quarters.
That's almost 4 years.
It's a massive financial moat that a lot of competitors just don't have. It lets Pony AI focus on the long-term tech milestones without worrying about their next financing round.
Okay, so let's look at where that capital's going. The operational momentum.
Right, because this race is won on the streets, not just on paper.
By November, they said they had rolled out over 600 of the new Gen 7 Robotaxis.
Which brought the total fleet to over 900 vehicles. And that new capital is clearly giving them confidence.
You can see it in their forward guidance.
Absolutely. They're accelerating targets. They now expect to pass 1,000 robotaxis by the end of this year, 2025.
Which is ahead of schedule. And they're projecting the fleet will exceed 3,000 vehicles by the end of 2026.
And hitting that 3,000 vehicle mark would be a huge inflection point for their network effect.
So that's an aggressive acceleration. How can they possibly scale that fast without costs just exploding proportionally?
The answer is in the hardware cost, specifically the Gen 7 autonomous driving kits or the 80K.
That's the whole sensor suite, the computer, everything that makes the car autonomous.
And the bill of materials cost for that Gen 7 80K, they achieved a stunning 70% reduction compared to the last generation.
It's a 70% cost cut. That is a massive structural advantage.
And they're not done. They expect another 20% cost reduction for the 2026 production run.
Okay, so that's a hard cost moat, but that's only one part of the scaling puzzle, right?
The other part is that strategic pivot we mentioned earlier, the asset-light model. This is how they scale without burning through that $860 million war chest too quickly.
Explain that model for us. How does it work?
Well, they're partnering with third-party fleet managers like Sihu and Sunlight Mobility.
And those partners? They buy the cars.
They fund the vehicle capex, yes.
Yeah.
Pony AI provides the tech, the software, the platform, and in return, they collect that high-margin licensing and applications revenue.
The same revenue that we saw surge 354%.
Exactly. It lets them expand their footprint and get to vehicle density way faster than if they had to buy every single car themselves.
So they supply the brain, the partners supply the body and the budget. That's a powerful strategy.
As long as quality control is there, yes.
But let's talk about the real technology mode, the Pony World simulation platform.
Pony World is, it's staggering. It generates about 10 billion simulated test kilometers per week.
10 billion a week.
It's the lifeblood of safe scaling. It lets them test millions of edge cases without ever putting a real car at risk.
And management stressed something specific about what's in those 10 billion kilometers, right?
They did. They said 99% of that volume is focused on interactive agent detection, not just mapping static roads.
So it's not just driving around an empty virtual city.
Not at all. It's testing how the system handles unpredictable humans, cyclists, complex multi-car interactions. It's how the system learns and validates its safety profile at an incredible rate.
And speaking of safety, we should clarify a feature that I think gets misunderstood a lot. The remote assist.
Right. People hear remote and think someone is driving the car with a joystick.
Like a video game.
Which is a fundamental misunderstanding.
Yeah.
The system is level 4. It makes all its own decisions. The remote assistant never takes control.
So what does it do?
It only provides suggestions in really complex, weird scenarios. Think temporary traffic control at a weird construction site.
So the vehicle is always in charge, even if the network connection is slow.
Exactly. Safety never depends on the human operator. And their target proves it. A 1:30 ratio of assistance to vehicles by year-end. That's incredible efficiency.
Okay, moving beyond China, their global strategy is becoming a really big piece of this story.
It is. They're in 8 countries now, which shows the tech can generalize.
The new additions seem really strategic. Getting nationwide robotaxi permits in South Korea is a huge deal.
As is that partnership in Qatar with Mowasalat. It gives them a foothold in the Middle East.
And the push into the West looks just as strategic. They're planning deployments in Europe with Stellantis.
Right, using Peugeot e-Traveler vans in Luxembourg. And notice it's a commercial logistics entry point, not consumer ride-hailing.
That's a smarter, less regulated way to get into the market.
For sure. And then you have the partnerships with Uber and Bolt, the big ride-hailing platforms. That lets them tap into existing demand instead of building an app from scratch.
So despite crushing revenue, validating the unit economics, The stock is still pretty volatile. Why is the market still so skeptical?
It's the classic high growth, high cost conundrum. You've got 72% growth and better margins on one side.
But on the other, you have widening GAAP net losses and these high valuation multiples compared to, profitable software companies.
The market sees the execution, but it's still terrified of the sheer amount of capital required to win this race.
The stock did pop about 13% on the news, which was a relief rally.
But long term, their one-year gain is only about 5%. That's significantly lagging the S&P 500's 13-14% gain.
Investors know the goal is profitability around 2029.
And every single quarter until then is a test. Can the scaling and unit economics outrun the ballooning costs? The market is waiting for proof that they won't go bankrupt first.
Which brings us to our final segment. And as always, we have to emphasize, this is strictly a thought experiment. We are not financial advisors. Nothing here is investment advice.
Okay, so let's talk about an outrageous but plausible trade idea built on that dual listing and those scaling targets.
What's the thesis?
Go long the name aggressively into calendar year 2026. That 800+ million capital raise gives them a 14 to 15 quarter runway. That's a cushion competitors can only dream of.
So the market has priced in the losses.
But we'd argue it has dramatically underappreciated the strategic importance of that asset-light model combined with a huge capital buffer.
Okay, so if the market isn't appreciating it now, what's the catalyst that forces a re-rating?
The key catalyst is hitting, or even better, exceeding, the 3,000 vehicle fleet target for the end of 2026.
Because if the asset-light model works,
Fleet expansion will be exponential and capital efficient. And that will bring on the network effects, shorter wait times, higher utilization way faster than skeptics believe.
so the trade is basically a bet that the network effects are closer than the market thinks.
Precisely. The trade would be to buy long-dated call options, maybe with a mid-2027 maturity. You're anticipating a massive re-rating of the stock's multiple as that 2026 fleet target gets closer.
It's a trade that's entirely contingent on execution, on those partnerships really ramping up.
A high-risk, high-beta trade, absolutely. But the reward is tied directly to their operational success and that massive cash cushion.
Okay, so to quickly recap the highlights for our listeners, Pony AI delivered a big revenue beat, doubled their gross margin, and most critically hit unit economics break-even in Guangzhou.
And all of that momentum is being supercharged by the huge capital injection from the Hong Kong listing, which makes that 3,000 vehicle goal for 2026 seem very much within reach.
All right, what's the final thought for us to mull over?
The final thought is this. The real technological moat isn't just the fleet size or the hardware cost reduction. It's the Pony World simulation stack. They're cutting hardware costs by another 20%. While validating their system across 10 billion simulated interactive kilometers every single week. So you have to ask, if they keep that pace up, how quickly does that simulation capability become completely insurmountable for competitors? That technological lead might be the biggest hidden asset on their balance sheet.
And it might be what separates the true leaders from the rest of the pack in the level 4 race.
Something to think about. We appreciate you taking the deep dive with us today.